Good afternoon, everyone. I'm Amanda Hooper, Deputy Director of Outreach at the National Women's Law Center, and I'd like to thank you for joining us for today's webinar, Tax Credits, What Working Families Need to Know. We have a few technical notes to begin. First, during the webinar, all lines will be on mute. We will be taking questions after the presentations have finished, but you can submit questions throughout the webinar by typing it into your webinar toolbar and hitting send. Please also note that we are recording today's webinar, and you will receive a link to the recording as well as to the PowerPoint presentation within the next few days. Today we're going to hear presentations from 3 different experts. First is Christina Postolowski, who is Policy Manager at the Young Invincibles. After Christina, we'll hear from Amelia Bell, Fellow at the National Women's Law Center. And finally, Amy Matsui, Senior Counsel at the National Women's Law Center, will present. Again, after the experts give their presentations, we will open the floor for Q&A. Before we dive into the presentations, we want to learn a little bit more about who is joining us today. So you are going to see a series of a couple poll questions pop up on your screen. So the first question is, what year were you born? So you should see at this point on your screen question about what year you were born. So was it 1945 or before, 46 to 64, 65 to 79, 80 to 87, or 88 to 2000. So just pick the range that fits for you, and then I'm just going to give it a couple more seconds for people to answer. All right, it looks like about 80% of people have responded, so I'm going to go ahead and close this poll. Looks like 10% were born before 1945, 30% 46 to 64, 22% 65 to 79, 27% 80 to 87, and 11% 88 to 2000. The next question you're going to see is a question about your affiliation. So in what capacity did you come to this webinar? Are you joining as an individual? Do you work for a community-based organization or nonprofit? Do you work for the government, a union, or do you have another affiliation? So just go ahead. Okay, it looks like most people have voted at this point. Overwhelmingly, it looks like people are affiliated with a community-based organization or nonprofit at 65%. 19% of people are joining as an individual, 12% from the government, 1% from a union, and 3% from another affiliation. And the last quick question we have before we begin the presentations is whether or not, in a professional capacity, you help people prepare their taxes. So that's just a yes or a no question. So I'm going to give people a couple more seconds to go ahead and select whether or not you help prepare other people's taxes. Okay, I'm going to close the poll. It looks like 32% of people do help prepare others' taxes and 68% do not. So thank you all very much for your answers. At this point, I'm going to go ahead and turn the floor over to Christina from the Young Invincibles. Christina, the floor is yours.
Great, thank you so much, and hi everybody. So glad that you're able to join the webinar today. I'm going to talk a little bit about some economic challenges facing millennial families, sort of set the stage and provide some context around why these tax credits are so important, and particularly for new families, which are part of the millennial generation. Next slide. So just briefly, for those of you who don't know my organization, Young Invincibles, we are a national nonprofit, nonpartisan organization. We're based out of Washington, D.C., and have regional offices in LA, Houston, Chicago, and New York. And we are a millennial research and advocacy organization. We help raise the voices of young adults around economic issues affecting our generation, including access to health care, higher education, and financial security. Next. So we talk about the millennial generation. We're talking about young adults ages 18 to 34. Some things you might have heard about the millennial generation is that we're the most diverse generation. We're also the most educated. Increasingly, we are also parents and heads of households. There are over 20 million millennial parents, make up nearly 30% of the millennial population, and that number is growing. 83% of new moms are millennials. We're also the generation hardest hit by the Great Recession. Over 4 million millennial parents, or 1 in 5, live below the poverty line. Next. As you can see, the poverty rate has been going up for young adults ages 18 to 34 over the past 25 years, and the poverty rate is also higher for parents than non-parents. So that's particularly why some of these tax credits we're going to be talking about today are important for young families. Next. As I mentioned, young parents and young families are in the perfect storm of economic challenges right now. We're the most impoverished parents in a quarter century, and we're the first generation in modern history to have higher poverty rates and lower incomes than the 2 preceding generations. Some of the causes of this are wage stagnation and decline. Millennials have seen their wages decline by 10% over the past 10 years. The rising college costs and student debt are another cause of our financial insecurity. Single parents, in particular, graduate college with 40% more student debt than non-parents. Millennials also face a high unemployment and underemployment rate. The millennial unemployment rate is over 40% higher than the national average, still after the recession. And over the past 20 years, we've seen the cost of childcare increase rapidly. One interesting fact is that young moms in the last 20 years haven't entered the workforce in greater numbers than previous generations, in part due to the growing cost of childcare keeping parents at home. Next. This chart breaks down some of the costs of raising a child, compares the costs in 1960 to the costs in 2013. And as you can see, that child care and education piece at the top is really where we've seen the biggest increase. So this is an area where the child care and dependent tax credit, for example, is particularly important in alleviating some of those burdens on young families. Next. And just a brief look at some of the consequences for millennial parents of these economic challenges that we're facing. We're seeing young people who are foregoing education or career advancement, living with reduced financial resources, and making sacrifices in the quality of life to make ends meet. And that's really where some of these tax credits can help young people meet their financial obligations for the year and provide some added financial security for young families. Now, after that background, I'm going to go ahead and turn it over to Amelia to talk about some of the tax credits.
Thanks, Christina. I'm just going to speak in more detail about some of the tax credits that Christina was speaking a little bit about. If you could turn to the next slide, please. So eligible families can claim a good amount of tax credits, can claim a good amount of money today in tax year 2015. From the earned income tax credit, a family could earn up to $6,242, up to $1,000 per child from the federal child tax credit, and up to $2,100 from the federal child and dependent care tax credit. And then there's also the premium tax credit, which Amy is going to talk about a little bit more in detail later, which can help families purchase health insurance through the health insurance marketplace. Next slide, please. Additionally, many states offer similar tax benefits to families. For tax year 2015, 26 states will offer EITCs, 26 states will also offer child care credits, and 3 states will offer child tax credits. And these are in addition to the federal credits that everybody has access to. Next slide, please. These tax credits can be worth a lot of money, a little bit, as I mentioned before, especially if your state also has these tax credits. For example, if you live in New York, a family with 3 children that paid for child care could receive up to the $6,242 in federal EITC benefits, and then an additional up to $1,873 in state EITC benefits. They could also receive that $1,000 in federal child care tax credit benefits and up to $330 per child in state child tax credit benefits. Additionally, they could also be eligible for up to $2,100 in federal child and dependent care tax credit benefits and up to an additional $2,310 in state child and dependent care benefits. Next slide, please. A little bit about how these tax credits work. Tax credits can lower a family's tax bill and possibly provide a cash refund. If a tax credit is non-refundable, it can lower a family's tax bill down to zero, but it cannot provide any additional refund. However, if the tax credit is refundable, it can erase a family's tax bill entirely and then also possibly provide them with a refund back at the end. Next slide. These tax refunds can help families save for a rainy day. Families can use their refunds to create an emergency fund or build up savings. One way they can do this is if they use direct deposit from their tax refund, they're able to split their refund and send some money to a savings account, for example, and the rest into a checking account. So they could slowly build up a little bit of savings every tax year. And many EITC coalitions can help families do this and provide other ways for them to build assets. Next slide, please. So which of these tax credits that I mentioned are the refundable credits, the ones that can help you get a tax refund in addition to erasing your tax liability down to zero? The federal earned income tax credit is refundable, as is the federal child tax credit. Additionally, 12 state child care credits and 13 state EITCs are refundable. However, unfortunately, the child and dependent care tax credit is not refundable, so the most it can do is bring your tax bill down to zero. Next slide, please. A little bit more in detail about the earned income tax credit. The federal earned income tax credit is a wage supplement for low and moderate income families. And in general, the value of the credit is based upon a family's income and the number of children in that family. But there's also a smaller credit available to individuals and couples who do not have children, but it's significantly smaller than the credit available to families with children. Next slide, please. How much is the EITC worth? It's based on your annual income, and that up to the $6,242 that I mentioned would be for a family of 3 or more children who earned less than $47,747 in 2015. Your child must be under the age of 19 or under the age of 24 if that child is a full-time student. Any child that you're claiming has to have lived with your family in your main home in the United States for at least half the year. And then this slide also details some of the more specific amounts if your family has fewer children, or also if you're an individual without children. And you can see how much the credit drops for the individuals without qualifying children. Next slide, please. The child tax credit gives you $1,000 per child in your family, no matter how many children a family might have. For example, the example given, if you have 6 children, you can claim a $6,000 child tax credit. And that credit is also refundable, as I noted. So if your total tax bill is over or is under $6,000, you can get the remainder back as a tax refund. Next slide, please. A little bit more on that. For your refund, the family will receive either 15% of their income above $3,000 or the amount of the child tax credit that exceeds their tax liability, whichever is less. For example, a parent earning $8,500 with no income tax liability will receive a refund of $825 from the child tax credit. Next slide, please. The last tax credit I'm going to talk about is the Child and Dependent Care Tax Credit. For this credit, a child must be under the age of 13. And this credit is designed to help families meet their child and dependent care expenses. It can be used for any type of care. The examples given: a center, a family daycare home, a church, a neighbor, a relative's house, anywhere where you pay for child care. This credit can also be used to pay for care for disabled dependents or spouses that you pay for care for. But I will note that if you pay one of your dependents, for example, if you pay your teenager or a dependent grandparent to watch your children, you can't claim those expenses under this tax credit. Next slide. So this, how much is this tax credit worth? It's worth up to $6,000, or sorry, a family can claim up to $6,000 in child care expenses for 2 or more children or dependents, or $3,000 for 1 child or dependent. And generally, the lower your income and the higher your expenses, the higher the credit you receive will be. So depending on your income, a family can receive between 20 and 35% of those qualifying expenses mentioned in the first bullet. The percent of expenses a family can claim depends on your family's adjusted gross income, but the most reimbursement a family could receive is 35% of the expenses, so 35% of the $6,000 if you had 2 or more children. So the tax credit is worth a maximum of $2,100 for 2 children or dependents and $1,050 for 1 child or dependent. And again, because this credit is non-refundable, families can only use it to reduce their tax liability, but this can increase their other refunds. Next slide. One additional important thing to remember about this tax credit is that the care must be employment related. That is, the adults in the family must use this child care so that they can look for work or that they can work. There's one exception to this rule, and that's for married couples. And they are still able to claim this credit if one spouse is working and the other spouse is a full-time student. However, a single parent can't claim this credit if they are a full-time student and not working. They are required to either be working or looking for work while using this child care. Next slide. So this is just a little cheat sheet on some of the eligibility requirements, the age of the children, and the maximum credit values you could receive under each credit. Next slide, please. Sometimes we get a question of whether or not these refunds can affect your eligibility for other benefits, and in short, the answer is usually not. The amount of a refund from the child tax credit or the earned income tax credit cannot be used to determine eligibility for or the amount you receive in Medicaid, supplemental security income, food stamps, or low-income housing. Additionally, the child tax credit refund cannot be used to determine eligibility for or how much you would receive in TANF benefits or temporary assistance for needy families. Next slide. However, states are able to develop their own rules on whether the earned income tax credit refund could be used to determine eligibility for or the amount of TANF benefits. Next slide. So just a couple quick bullets about how you actually claim these tax credits. To claim them, a family with children has to file the IRS form 1040 or 1040A, but not the 1040 EZ form, the shorter form. Families must also file a separate form for each federal tax credit, but you can also go back and amend tax returns from previous years. It's also worth noting that states have different forms and procedures for claiming the state tax credits I mentioned, so it's a different process for the federal credits and the state credits. And now I'm going to turn it back to Amanda for a quick poll question, and then she'll turn it over to Amy Matsui, who will talk about the premium tax credit more.
Thanks, Amelia. So as she mentioned, we're going to do a couple more quick poll questions that have to do with the next slides. So the first question is just a quick yes or no. Do you have children, or if you're serving a population, is it usually a population with children? Okay, so we'll give folks a little bit more time to respond, either yes or no. I'm going to go ahead and close the poll. Looks like 74% said yes and 26% said no. And then our final poll question is about the premium tax credit and how familiar you are with the premium tax credit. So the options are you're not at all familiar, you are somewhat familiar in that maybe you've heard of it or you've heard people talk about it. And then the last option is you're very familiar with the premium tax credit in that you've used it or you've helped somebody else use it, either now or in the past. So give people just a couple more seconds. All right, I'm going to close the poll. Looks like about half of the people on the webinar are not at all familiar. 32% are somewhat familiar, and 17% are very familiar. Okay, Amy, the floor is yours.
Thank you so much, Amanda. And we want to thank all of you for joining us today on this webinar. The tax benefits that we're talking about today are incredibly important supports, and they're really kind of a priority for both the National Women's Law Center and, as Christina mentioned, for Young Invincibles, because we want to make sure that families, young families and families with kids and female-headed families in particular, are able to have the resources they need to make ends meet. And these tax credits are a super important way to be able to do that. So we appreciate getting kind of a sense of your general familiarity with the premium tax credit, and this is hopefully going to be useful information for you as we embark upon another open enrollment season for the Affordable Care Act. So just to give you a little bit of background about the premium tax credit and what it does to help families pay for health care insurance. As you all know, the Affordable Care Act, which is the health care law that's sometimes referred to as Obamacare, is opening up health care coverage and expanding it for millions of American women and their families. So in 2015, almost 12 million people signed up for health insurance through the marketplaces, which is the term for the exchanges where people can sign up for health insurance. And over 85%, actually almost 90% of these people qualified for financial assistance that's intended to help them meet the monthly cost of health insurance so they can get the care that they need. Next slide, please. So we are, as I mentioned, in the 2016 open enrollment period. This means that people can sign up for health insurance or, and this is really important, can change the health insurance plan for which they're enrolled. It started on November 1st, and it's going to run through January 31st, 2016. This coincides with the period when most people who are employed look at their different benefits and make different elections at their place of employment. So this is kind of the same benefits season, as it were, for health insurance through the federal marketplaces. And even if families or individuals don't make changes to their health insurance enrollment during open enrollment period, if people have life changes which include marriage or divorce, birth or adoption of a child, or a job change, they can and should go back to the marketplaces to make sure that those changes are noticed and included in the health care coverage. So if you or the families that you serve have questions about enrollment in healthcare insurance, healthcare.gov is the place to start, and the 1-800 number for the healthcare.gov entity is also included on the slide. It's 1-800-318-2596. Next slide, please. So what the premium tax credit does and how is it related to your enrollment in health insurance through the marketplace? The premium tax credit can be received by individuals as help to pay for people's monthly premium payments. It helps people buy health insurance by offsetting some of the cost of the premiums every month. As soon as individuals and families sign up for health insurance, the premium tax credit is available to them. The way that the premium tax credit is calculated is based on the household income and family size. The credit, if someone elects to get an advanced premium tax credit, it is paid directly to the health insurance company each month. So it goes straight from, the person who's enrolled in the health insurance doesn't have to do anything. The payment of the credit for the advanced premium tax credit goes straight to the health insurance company. And then at tax time, when families file their 2015 tax return in early 2016, they will calculate what their final premium tax credit total is. And as we'll talk about in a little bit more detail shortly, the adjustment happens between the advanced payment tax credit payments that were made and the final total of what premium tax credit the individual or family was eligible for. Because the premium tax credit is based on household income and family size, any changes to one of those two factors should be reported to the health insurance marketplace throughout the year because it can affect the size of the premium tax credit. So some people may think that even though the family had a baby in August, that they should wait until the open enrollment period to notify the marketplace, and actually that's not true at all, and instead they should report those changes as soon as possible after they've happened, both to family size and also to the amount of income. Next slide, please. So just a little bit more information about getting down to a little bit more level of detail about the premium tax credit. How do people qualify, and how much assistance can they receive? So the basic kind of guidelines for what people are eligible for the premium tax credit are those with between 100 and 400% of the federal poverty line. What this means for 2015 is that a family of four with income between about $24,000 and about $97,000 will be eligible for the premium tax credit. The credit is designed so that whoever the individual or family is, they're not spending more than a certain percentage of their income on health insurance. And so the premium tax credit is a sliding scale. It's worth more for people who have less income and worth maybe a little bit less proportionately for people with higher income. And then finally, the way that the premium tax credit works, I mentioned that it is paid on a monthly basis and it goes directly to a healthcare insurer. But what it represents is the difference between the actual cost of the health insurance plan and the contribution by the family. So it's kind of a gap filler. Next slide, please. So let's walk through an example about how the premium tax credit is going to be calculated and used for the Smith family. So we have a married couple with 7-year-old twins, and they have a household income of $48,500. This represents about 200% of the federal poverty level. What the family wants is to purchase a silver benchmark health insurance plan. For those of you who are familiar with the different kinds of insurance plans offered through the marketplace, you know that there are a number of different levels. So there is the bronze level, silver, gold, platinum. So the silver benchmark level is kind of a medium in the middle cost health insurance plan. So at the income level of 200% federal poverty level, this family is required to contribute no more than 6.3% of their annual income. And this translates into just over $3,000 towards their health insurance premiums. But the total annual premium for the health insurance plan in their area is $9,000 for the Silver Benchmark health insurance plan. So the way that their premium tax credit is calculated is the difference between $9,000, which is the total annual premium, and $3,000 and $55, which is their contribution. And when that's divided up on a monthly basis, it's equal $400 to $495 per month. So every month, their insurer will receive directly $495 as a premium tax credit. John and Maria, the married Smith parents, will have to send in $255 a month to the insurer to meet the rest of the cost of the premium. So their total premium minus the premium tax credit, which they're receiving on an advanced basis, and their contribution, and they will be all paid up for their health insurance premium for that month. Next slide, please. So a couple of important things to note for the premium tax credit in tax year 2015. The first is that if you or if an individual or family received a premium tax credit in the 2015 calendar year, it needs to be reported on the tax return that is filed in 2016. So any individual or family who received an advanced premium tax credit throughout the year in 2015 has to file a federal tax return in order to report the premium tax credit, if for no other reason. When the tax return is filed, the health insurance marketplace will give information about the premium tax credit, the advanced premium tax credit payments, to the IRS, and then the tax filer will reconcile the tax credit that was received and the tax credit that they're eligible for. The reason that this has to happen at this point is that when someone signs up for health insurance, they're making their best guess. They are projecting what their income is going to be in 2015 and what their household size is going to be. And at tax time, when the return is filed, the IRS and the marketplace can look and see what was the person or family's actual income and what the actual family size is. And this is why it's incredibly important throughout the year to make any changes in income or in family size to the marketplace. So just one kind of cautionary note for families and individuals who are signing up for health insurance in the marketplace. In open enrollment season that's going on right now through January 31st, 2016. For people who don't know what their income is going to be or expect that there are going to be changes in their income, whether it's because they work part-time or they work seasonally or their job and income is just a little bit unpredictable, those people should note that they can choose the amount of the advanced premium tax credit that they receive. They may want to receive a smaller advanced premium tax credit if they're very concerned that they might have to reconcile and pay back some of the credit at tax time. So that's just kind of a note to think about for families and individuals who aren't entirely certain what their income is going to be. And at this point, I want to just pass the microphone, so to speak, over to Christina for a couple of thoughts reflective of Young Invincible's experience, which is extensive, in helping folks enroll for healthcare through the marketplaces.
Great, thank you. So for those of you on the phone who are individuals who might be looking for insurance coverage or who work with young people who are signing up for insurance or other benefits, I just really want to encourage you to get the word out to your friends and family or to people you work with about the financial help that's available for insurance coverage. We're in the third year of open enrollment in the health insurance marketplaces now. However, the majority of people still don't know that these benefits are available. And for young people in particular who tend to make less money and might not have insurance coverage through their job, this is really the way that they can get covered by getting a discounted plan on the marketplace. It's a common misperception that young people don't want to have insurance coverage, but polling has showed that most people want to have the coverage, they just can't afford it. And through these premium tax credits, coverage can be affordable for people who may not have been able to buy it before. So if you've got a friend or family member or someone you're working with who just hasn't signed up, doesn't know, doesn't think they're going to be able to afford it, and encourage them to check out Young Invincibles' Health YI mobile app, which has a built-in discount calculator, so you get an idea of what a plan might cost you up front before you go and apply.
Thanks, Christina. And that's a really good way for us to segue to the next slide, which focuses on, this is all a lot of information that we've just given you today, and we hope it's helpful information for you and the families that you serve. And we want to focus our attention for just a couple more minutes at the end of this presentation about how you can get this information to the families who need it most. Next slide, please. So we've tried to boil down into 5 easy steps, ways that you can help spread the word about these valuable tax credits to the families who need them the most. Next slide. So the first is that you can get information and resources with facts and information about the tax credits. Our site is currently under construction, and we'll be updating it as we revise our materials for this tax season. But one thing that we do have on the National Women's Law Center's website, and the link is on this slide, is we have flyers for every state which list out not only the federal credits that we've talked about today, but the state credits for which families may be eligible. So earlier in the presentation, Amelia pointed to a family in New York who could be eligible for federal and state EITC, federal and state child and dependent care tax credits, and federal and state child tax credits. And so the New York flyer will have all of those credits listed out along with the maximum amounts of that those credits can be worth for families. And so these are resources that we hope you will take and download and distribute. They'll be available in Spanish and a couple of other languages shortly, but they're available for you today in English, and more will be coming shortly. So in addition to the information about the tax credits, those flyers also have information about how to get free tax preparation assistance. And this is the second easy step to help families claim tax credits. Through the Volunteer Income Tax Assistance Program, which is kind of sponsored and trained through the IRS, free tax preparation is available in communities around the country. You may have come across these in libraries, community centers, churches, or child care centers. And for families who earn just around the $50,000 mark, volunteers who are trained by the IRS are available to help families prepare their tax returns. As you could see from the slide that we had earlier talking about the kinds of documentation and forms that need to be filled out, it can be a little bit complicated for families to claim all the tax credits for which they may be eligible, but VITA sites can help families do that. A lot of the VITA sites will also have assistance available in other languages, depending on the community in which they're located. And in addition to VITA sites, I want to flag that the AARP has a similar program called Tax Counseling for the Elderly. And then on top of that, for families making under a certain amount of money, slightly higher than the VITA limits, there are there's something called the Free File Program, which you can access through the IRS's website, which gives moderate income families access to free tax preparation software that helps them file their taxes. And that's also a great way for families not to miss out on important credits. They won't have to pay fees, which can cut back into their refunds. And some of these free tax preparation sites will also help families open bank accounts or do other things that can help them maximize their savings and build assets. So again, as we're making it through the tax season, please keep checking back on the National Women's Law Center's tax credit outreach page to get more information and resources for you. Next slide, please. So the last 3 steps that we'll note for doing tax credit outreach are spreading the word to families with children. You can do this by distributing the flyers that are available on our website. You can write a newsletter article, put links on social media, use your website, or you can even have the folks who answer your phones give information about tax credits. A little information or just kind of getting people pointed in the right direction can go a long way. Obviously, nobody wants you to be trying to give out tax information that applies to someone's personal situation over the phone, but at least you can point them towards the resources. We have templates that are going to be updated and available on our website soon, and we're also happy to work with you to develop any materials that you think are particularly useful for the families that you serve. In addition, you can partner up to expand your reach. There are EITC coalitions across the country that help families in a particular community get to free tax preparation sites. And there's a toll-free number, oh sorry, not toll-free. There's a phone number on the slide if you are interested in getting connected up with the EITC coalition in your community. And in addition, I'll just signal that we are going to have a second webinar next month which talks about connecting more specifically with these EITC coalitions and things that your organization can do to help get the word out. And then finally, a really important aspect of tax credit outreach is just to keep track of families' success stories. So it may be that a family in your community and a family that you serve with your organization was able to buy a car with their tax refund. They may have been able to make back rent or get some much needed dental care, some kind of big purchase that really helped them kind of get back on their feet. And these are important stories that make clear to the community at large about how important the tax credits are for families and their economic security, and they can be an incredibly important policy tool as well. So we encourage you to keep track of those stories, share them with us if you're comfortable doing so, and hopefully those are stories in people's personal voices and those situations of families who are working hard to make ends meet that can make a difference on a policy front. And then finally, we encourage you, if you're interested in participating in tax credit outreach, receiving monthly emails during tax season, or engaging with us further on tax credits, to become a community partner with the National Women's Law Center. And there's a sign-up link on the slide as well. Next slide, please. So we're going to have a little time now to have questions from the audience, and I'm going to leave you with the last 2 slides in the PowerPoint have resources about, the first slide has resources to give information about enrollment through the Affordable Care Act and the health insurance marketplaces. The first of those is the app that Christina mentioned earlier, and then the second is a toolkit through the National Women's Law Center, which is available on our website. And Amelia, at this point, let me turn it over to you to see if we've got some questions from the audience. Thanks, Amy. Looks like we have a number. I guess to start, one of the first questions is for the child and dependent care tax credit. Does the tax filer have to report a EIN or a Social Security number for the child care provider?
Sure, and I'll jump in and take a first crack at that. So when you're filling out the separate form for the Child and Dependent Care Tax Credit, the IRS is going to ask you for identifying information for your child care provider. However, if you have asked for that information and the provider does not want to provide it, as long as you've asked, there's kind of a place on the form where you can note that. So although it is information that you should try to get, the IRS understands in a way that it's not always possible to get that information.
Thank you. And then also related to the Child and Dependent Care Credit, sort of a two-part question. The first one is, what is the minimum and maximum age of the Dependent Care Credit? And then additionally, is this something that the tax filer gets when you file taxes or something you get as during the benefit tax year through a payroll deduction?
Let me answer that in a couple of ways. So to answer the age question, so if you look back on the cheat sheet that's in the slides, the Child and Dependent Care Tax Credit is available for people who are claiming expenses for children under the age of 13. It can start as soon as the child is born, but under the age of 13. The age ranges for disabled dependents are a little bit different because you can claim expenses for a disabled spouse, and if your child is disabled, there's not an age limit for that. But if it's for child care expenses for a non-disabled dependent, it's for kids under the age of 13. And then the way that the credit works is that the credit counts against your tax liability, and that happens at the time that you file your taxes. There is another tax benefit that's available to some people, but not all. If your employer offers a cafeteria plan for child and dependent care expenses, you can make contributions from your earnings and put them in this dependent care cafeteria plan account. When you do that, you're not going to pay income taxes and you're not going to pay payroll taxes or employment taxes on that amount of money. And then throughout the year, as you pay for child or dependent care, you can get reimbursed through your cafeteria plan account. So that is not, that's going to be taken into consideration when you file your taxes, but the contributions and your reimbursements can happen throughout the year. But that's a different benefit. That's a cafeteria plan. It's not the tax credit.
Great. I'm going to turn to a few questions that we have about the premium tax credit. The first one is the 6.3% noted in the slide that you would pay for health insurance, is that based on your gross or net income?
So I believe that there's a special measure of income that's used for the premium tax credit. I don't have at the tip of my tongue what that measure is, but I think there's information which is available on the IRS's website because they have a number of resources for the premium tax credit. Christina, does that sound right, or if I mangled that 100%?
No, that's right. It's based on your modified adjusted gross income, or MAGI, which is going to be for most people very close to their AGI, or adjusted gross income, on their tax return.
Okay, thank you. And then another question we recently got was, what happens to the premium tax credit for families who are below 100% of the poverty line?
So that's kind of complicated and depends on whether your state has expanded Medicaid or not. So for background, for those who don't know, the Affordable Care Act envisioned that everyone between 100 and 138% of the federal poverty level would get covered through Medicaid, and everyone 138 to 400% would get covered through a marketplace plan with tax credits. The Supreme Court decision in 2012 made it optional for states whether to expand Medicaid or not. So far, about 30 states have expanded coverage. So in those states, people below 138% generally would be covered on Medicaid, and between 138 and 400 would be covered through tax credits. For the 20 states that have not expanded Medicaid yet, for most people who are below 100% of the poverty level, they're going to fall in what's called the Medicaid gap. So they do not have access to tax credits, and they also do not have access to affordable plan through Medicaid.
Thanks, Christina. And then there's a question that either possibly Amy or Christina could speak to about whether many of these tax credits, both the premium tax credit but also the tax credits for working families, whether many of them remain unclaimed, and possibly if you had any thoughts on some of the reasons behind why some families wouldn't claim tax credits that they are entitled to or that they qualify for.
This is Christina, and I'd say the biggest reason that we've seen is that lack of knowledge. A lot of people, young people in particular, just don't know that these tax credits are available to them. So that's why we really need everyone's help to get the word out.
And just to echo that, the statistics show that even for the EITC, which is a very well-known credit and one that has been around for decades and people know how valuable and important it is as it is, and kind of on top of that, the importance of it is shown by the fact that some of the coalitions that work on free tax preparation assistance are just called EITC coalitions because that's kind of seen as a really important one. Even for the EITC, 1 in 5 eligible families doesn't claim it. And so I think that that goes to what Christina mentioned, is that it's impossible for everyone to know about them, and then also for families who may know about them, they may just not have the ability to connect with the resources that can help them claim it correctly. And that is really the service that the VITA sites and the other free tax preparation assistance can help them with. So letting people know that the credits are available and that there are resources to help them claim them is, again, just really important for families' economic security.
Thanks. And then I think one last question that we've received is for government employees, is there a difference, or is it better for a federal government employee to use the government's health insurance marketplace for federal employees, or the Obamacare marketplace to better utilize the premium tax credits, or are they the same?
This is Christina. I would suggest for folks who do have a choice of plan, whether it be through the federal government or their employer or their spouse, to take a look at and compare costs. You might be better off on the marketplace. You might be better off in your employer plan. That's going to really be on a case-by-case basis. One thing to note is that if you do have an offer of coverage from your employer that's considered affordable, which they define as being about 8% or less, costing about 8% or less of your income, you will not be eligible for tax credits on the marketplace.
Okay, great. Well, I think that about wraps it up for the questions we've received. If anybody has any last-minute questions, I'm happy to wait a minute or so. But otherwise, it looks like we are finishing up, unless Christina or Amy have anything else that they would like to add.
So this is Amy. I just want to thank everybody again for joining us on the webinar, and thanks so much to Young Invincibles for participating in this. This is, again, one of the things that we think is really important for families' economic security, and so we really appreciate the chance to talk to all of you today about tax credits and getting the word out to families.
Thanks. And I just want to remind everybody that we will send around the slides and the audio so that you can refer back to anything that you might have missed. And now I'm going to turn it back over to Amanda, who's going to talk to you about a closing survey.
Thanks, Amelia, and to all of our presenters today and to all of you who joined us for the presentations. At this point, we're going to go ahead and close the webinar, and I just wanted to let you all know that when you do exit the webinar, you'll get a prompt to take just a quick exit survey, and we appreciate your time both joining us today and also just for a few minutes to give us some feedback about the webinar. So with that, I'm going to close out, and thank you all. Have a good rest of your day.